Paul, I want to go to your wheelhouse, which is gaming the capital expenditure culture and belief of the big oil companies, the E&P companies, given CapEx inflation. It's gotten expensive to find the next marginal barrel.
Well, not in the Permian. I mean, I think they know where the oil is in Texas, but what they've stopped doing is spending the money that you're referring to on global exploration or trying to find the next big thing. Now, they have found one next big thing, which is Guyana, but that's just about all that's been significantly discovered over the past decade. And as you say, the expense of finding oil and the uncertainty of finding new oil, particularly, is really constraining global capacity badly. And then, as you've referred in the program already, OPEC just is out of capacity. I don't see it as a slap in the face from OPEC to the Biden administration. I see it as more of a shrug or a we're powerless move that they really can't add any capacity. There's only Saudi and UAE that have any spare capacity left. And as was also noted, OPEC actually highlighted that they don't have any spare capacity and they're worried about it. So there's a real problem out there. And if it wasn't for the SPR release, the million barrel a day SPR release, we would be a lot higher.
They're not keeping it a secret. So walk me through things for next year, Paul. If we don't get a recession, if China comes back online, what this commodity market actually looks like, particularly in crude.
Yeah, funnily enough, I was thinking about that just this morning because 2023 does set up, and beyond actually, for very, very strong. Now, the one thing that is notable is that we're seeing weak US gasoline demand, and people are blaming that on government conspiracies and other nonsense. I think the cars are more efficient. If you look at vehicle miles traveled, they're high. So it's not necessarily a change in behavior. What it is a change in the kind of vehicle people are driving. And it's obviously not EVs, electric vehicles. It's just more efficient cars that turn off in traffic jams and everything else. I think that's what we're seeing, combined with marginal behavior change where people are less wasteful with gasoline when it's expensive.
Wait, Paul, are you saying that that shift in the type of vehicle has happened in the past 2 years so dramatically? Because what this data showed from the EIA was that the amount of driving over the summer has been less going back even to 2020 during the peak of the pandemic.
Yeah, you've got me a bit with that one because the speed of the change does look like there's also marginal behavior change. But I think underlying it is a rolling significant increase in new car efficiency that would have a significant effect at the margin on US gasoline demand. Well, there's a tremendous amount of demand for gasoline in the US that's discretionary. And I think people also just take that one less trip, and everyone tends to behave in the same way. And that's the other effect that we're seeing as a result of high prices.
Paul, are you surprised that the market isn't responding more to the OPEC Plus saying themselves that they're bumping up against the limits of how much they can produce? That previously would have produced a really big response in markets. And it basically was just another thing in the day that got forgotten very quickly.
Yeah, I think it's like the yield curve. I think what you're seeing is the back end of the curve for oil is holding up. I still think it's low. But it is holding up as the front month is coming down. The front month is being attacked by the SPR in a very big way. So I think the big question, as John is highlighting, is what happens when we get China back and then the SPR has to turn off, I think, post the midterms. That really sets up for a very powerful 2023. This tape today, this equity tape, isn't buying 2023. It's buying a short-term bounce, short covering move. And as a result, nobody wants to own an oil company as they see the oil price falling towards turnaround season for the refiners. Turnaround season for the refiners will be the more important demand effect that we see over the coming months. Yeah. So I'm kind of bearish right now, to be honest with you.
What's your oil price out 1 year? I mean, I'm confused here in that I'm hearing so many cross currents. Are you able to guesstimate Brent a year out?
Well, we had said that we thought you'd see 110 to 150 through summer, so we're losing that. It's tried to hold that level, but has essentially failed. I think it's easy to argue for $100 oil on an ongoing basis starting in 2023. I don't think you'll do much above 150 over time, simply because the demand elasticity, the effect of the strong dollar combined with that kind of oil price will hold you below that level. I'm not a buyer of the 200, 250 type crazy numbers. I just don't think we can sustain that.
Paul, just to be clear, you slipped in the word bearish. Near term, what's the downside?
Bearish? Me? Nobody wants a bearish oil analyst. I think over the next few months, as long as this SPR, which is going to keep coming at 1 million barrels a day, You know, you've got to think that the whole of OPEC just added 100,000, and we're pumping a million a day that the US refiners can't absorb. It's too much for their capacity. They're running at full capacity. So the oil is actually being exported. Now, that is terrible energy security policy. There's no question about that. It's good market policy because they're hammering the oil price. So I think the other way of looking at it is, wow, we're at 90 with 1 million barrels a day of SPR release, which is an all-time historic high. You know, it's a huge number at the margin, you know, to be releasing that much oil on such a sustained basis. And it's going to happen for months more.
Downside, Paul, what's the number?
People are pointing, technical analysts, you know, great chart readers like you, John, are pointing at 80.